we've derived the short-run supply curve for a market and explained the distinction between the short run and the long run, we're ready to derive the long-run supply curve for a market. The relevant difference between the short run and the long run in this case is the fact that whereas the number of firms in a market is fixed in the short run, firms can enter and exit a market in the long run. In order to think about long-run supply, therefore, we first need to understand what makes firms enter and exit a market. Not surprisingly, the potential for economic profit and the threat of economic losses drive firms to enter and exit markets. It's important to remember during this analysis that economic profits are different from the accounting profits that people typically think about because economic profits take opportunity costs into account. By this definition, if firms in a market are earning positive economic profits, these firms are doing strictly better than they could in other markets. It's not surprising then that other firms will want to enter a market and try to get a piece of the action when they see positive economic profits. So positive profits lead to market entry. Conversely, when firms earn negative economic profits or economic losses, it means that these firms could do better in other markets or industries, so they'll want to leave and take advantage of these other opportunities in the long run, since that's when they have the chance to actually do so. Simply put, negative profits lead to exit. Putting these two findings together, we notice that the only scenario in which there's neither entry nor exit is when profits are at zero. Since equilibrium is defined as the steady state of a market, equilibrium is when there's neither entry nor exit occurring in a market. Not surprisingly then, firm profits are zero in a long-run competitive market equilibrium. In order to construct the long-run market supply curve, we need to incorporate the effects of entry and exit into our model. In order to get some intuition for why the long-run supply curve looks the way it does, let's examine what happens both in the short run and in the long run to changes in demand. Here, I've drawn a market supply and demand curve where our market was initially in a long-run equilibrium. So you can see here, if we look at the original demand curve, which is this first guy here, and then the original short-run supply curve, we can see that they intersect at a price that I've labeled P star sub LR for long run. And we know that this is a long-run equilibrium price because here in this second panel, I've drawn the cost curves for a typical firm in this market. And right now we're making the simplifying assumption that all of the firms in the market are identical, meaning they share the same costs. So any firm in our market would have costs that look like what we see here. And we can see that this long-run equilibrium price corresponds to the minimum of our average total cost curve, or profit is of zero, as we said before. So we can examine what happens when we move from this long-run equilibrium here to a new equilibrium as a result of an increase in demand. So here, I've drawn in a new demand curve that represents an increase in demand because we've shifted demand to the right. Now, the first thing that we can look at here is that in the short run, we see exactly what we saw when we talked about this idea of comparative statics earlier. We can see that in the short run, we get an increase in both price and quantity, and in the short run, we move from this equilibrium down here to this equilibrium up here. So let's label this new price, I'll call it P star sub SR for short-run equilibrium price. So we can then think about what happens as a result of this increased price to the profits of our typical firm. And we said that the firm profits started at zero. Well, now what we see is, again, for a competitive firm, firms maximize profit and they set quantity where price is equal to marginal costs. So we can see with this new increased price that this firm is going to be producing more than it was before, because now our new price intersects marginal cost here. And we can see, I'll call this Q star sub SR, We can see that they've increased their production a little bit. We can also see that this firm is now making a positive economic profit because, again, we said that profit was equal to our quantity times our markup over average cost. And we said that that was a rectangle that starts at price, goes down to average total cost at the quantity we're producing, and then extends to the left so that the width of our rectangle is our quantity. So what we can see here is that this price increase as a result of our demand increase resulted in positive economic profits for each individual firm in the short run. And it also resulted in an increase in production for each individual firm in the short run. So up until now, this is where our analysis has stopped. But now, because we're considering the long run, we want to think about what happens once we allow for entry and exit into this market. So we see here that so far all I've done is recreate what we saw in this first panel over here. And now we're going to think about what happens when we have entry and exit. Well, we said before that positive economic profits were going to induce entry. And it stands to reason that if we have entry into a market, the way that that's going to be represented is an increase in supply. So what we're going to see is a rightward shift of this short-run supply curve. And in fact, we're going to see firms entering the market up until this point here. Because basically what's going to happen is new firms are going to enter the market. As we said before in our discussion of comparative statics, an increase in supply increases quantity and drives down prices. So firms are going to enter the market until the price is driven back down to, surprise, surprise, this long-run equilibrium price. So we're going to see this rightward shift here as a result of entry. And then we're going to see our price being driven back down to this point here. You'll notice that this now corresponds with, for our individual firm, the same thing as we had before. We said that we started with a scenario where economic profits were zero. Price was at the bottom of this average total cost, U, and firms were producing a quantity Q star sub LR. Now what we're seeing is that we're actually just coming back to this original point. So that for any individual firm, in the long run, they just come back to what they were doing before. And this is simply because as firms enter, and that drives the price down, the existing firms roll back to their original quantity here. And because of the price decrease, they also roll back to their original profit of zero. To summarize, we get the overall chain of events that I've described up here. That when we have the price get driven above the minimum of average total cost, as we saw here, this time we were driving the price up because of an increase in demand, that results in individual firms having economic profits of more than zero. That's just what we saw in this picture here. As it turns out, not only do they have economic profits of more than zero, they're increasing their production quantity. These economic profits induce entry from other firms, because other firms want to get out on this good deal. So we see that we get entry, and that entry shifts our supply curve to the right because we're increasing our supply. Increasing our supply, as we learned way back in the beginning of the course, pushes down prices, and these prices in turn drive down the profits for all of the firms in the industry. And as it turns out, we'll keep pushing these profits down until they come back to zero. So that has particular implications for both individual firms and for the market. For individual firms, they may see a temporary positive profit, they may see a temporary increase in quantity produced, but in the long run, the original firms come back to doing exactly what they were doing before. They come back to this profit of zero. For the market, we can think about the overall long-run change in the market equilibrium. Well, the market started here at our original supply and demand curves, and the market ended up over here. So it ended up at the same price it started at, but it ended up at a higher quantity, because even though we have each firm producing the same amount as it did before, we have more firms because of this entry. So we can see when we have an increase in demand in the long run, we end up seeing an increase in the quantity produced because we have more firms, but we don't see an increase in any individual firm's quantity or profits. We can also examine what happens in the long run when we see prices and profits moving in the opposite direction. To do this, let's consider what happens in the long run as a result of a decrease in demand. So again, as a first step in this first panel here, we can see that I have an existing short-run supply curve that represents the current number of firms that I have in the industry. And I can see that as a starting point, we're intersecting at this P star sub LR, just our long-run equilibrium price. So we start here. And then what we see here is we see a decrease in demand. So we're moving to our demand to the left for whatever reason. And in the short run, we see the effect on the market being just what we saw, again, when we discussed comparative statics. We see in the short run our equilibrium moves from this intersection of supply and demand here to this intersection of supply and demand here. So in the short run, we move to a lower market price and a lower quantity. And we can think about what implications this has on the individual firm, because we can see if we're moving to this new short-run price, which I've labeled P star sub SR, we can see what happens to the firm's production decisions as a result of that new lower price. And again, because profit is maximized where price is equal to marginal cost, that with our new short-run price is going to be at this point here. So what we see is in the short run, we see this firm producing less than it was before as a result of this change in demand. And that's not surprising, because we're seeing here not only a reduction in price, but also a reduction in quantity. And that reduction in quantity comes about because, despite the fact that the number of firms is fixed, each firm is producing less than it was before. Like, okay, this all makes sense, this fits together. We can also notice that now, because the price is below the minimum of the firm's average total cost curve, the firm is going to be making losses or negative economic profits. We're going to assume for the moment, just for simplicity, that the firm is actually going to produce at this quantity and that the shutdown condition doesn't get triggered. I'm going to say, well, they're actually going to produce this quantity because it's better than producing nothing, but it's nonetheless going to result in an economic loss. And we can represent that graphically in a similar way to how we represented profit earlier. So here we can see that again, the losses are just represented by a rectangle. The height of that rectangle is just the difference between average total cost of the quantity we're producing and the price. So you can see ATC minus price here. And again, just extending this to the left to make a rectangle with our width being quantity. And this here represents the economic losses that the firm is facing. So in the short run, what we see for the market is we see a decrease in market price as a result of the decrease in demand, and we see a decrease in market quantity as a result of the decrease in demand. In the short run for the individual firm, what we see is a reduction in quantity for the individual firm, and also we see economic losses for the individual firm. So now we can think about, as a result of entry and exit, what's going to happen in the long run. Because we see firms making negative economic profits or economic losses in the short run, as we described here, we know that in the long run that's going to induce exit by firms because they're going to leave this industry and seek better opportunities elsewhere. So we can think about what impact this has on the long run situation, both for the market overall and for the individual firms in the market. So you can see here that I've started this third panel by just recreating what we've seen over here in the original short run situation. So I have my original demand curve, my decreased demand curve, and what we've shown so far is a move from this equilibrium point here to this equilibrium point here. Now, when I add firms exiting into this model, what we're going to see is that exit is going to decrease supply, or graphically speaking, shift the supply curve to the left. And we're going to see it shift to this point here. Call this S prime sub SR for our new short-run supply curve. And what we're going to see is that this reduction in supply due to exit is going to further reduce quantity in equilibrium, but it's also going to push the price back up. So you can see that when we're taking into account exit, we're actually moving from this equilibrium point here to this equilibrium point here. So what we're seeing is that exit by firms is actually serving to push the price back up for those firms that are actually left in the market. Now, we're actually going to end up pushing price back up until we get back to this long-run equilibrium price, because we're going to be pushing the prices up until the economic losses go away for the firms that remain in the industry, and we end up back at a point where we're making zero economic profit if we're still in that industry. So again, what you see from the perspective of the market is that we don't get a change in price. We're coming back to this long-run equilibrium price. But what you're seeing overall, if we were to call this the overall long-run effect again, is we're seeing a decrease in quantity without seeing a change in price, because we're coming back to that original long-run equilibrium price. So for the market, the overall effect is just we're just moving to the left horizontally. For the individual firm, we see that in the long run, we're coming back to a profit level of 0. Because again, we're coming back to that price that's exactly at the bottom of this average total cost curve, which is the price that corresponds to a profit of 0. Notice that we're also coming back to the same long-run quantity that our firms were producing before all of this happened. So from the perspective of the individual firm, in the short term, they had to ride out these economic losses, produce less, lose some money, etc. But in the long term, if they were one of the firms that actually stayed in the industry, they're coming back to the point they were at before. Now, to some degree, this begs the question of, if all the firms in an industry are making economic losses, which ones choose to leave and which ones choose to stay? And that process isn't actually well defined. Let's just assume that some firms are quicker to act than others, so they get out faster, and then the other firms see those firms leaving, they see the price going back up, and they say, oh, okay, I guess I'm going to stay here. There's some non-deterministic process that makes that happen, but nonetheless, this is going to be the end result that we see here. Furthermore, we can say as this adjustment process is happening, as this exit is happening, the individual firms are responding to the increase in the price both by having fewer losses, thankfully, but also by increasing their production quantity back from the short-run quantity to the long-run quantity. Again, we can summarize this effect by the chain that I put up at the top here. We can say, as our price dips below the minimum of our average total cost, as we saw here, it dipped below the minimum of average total cost because of a decrease in demand. But however it arises, that price decrease is going to result in negative economic profits or economic losses, which is what we showed here. In addition to the economic losses, we see that each firm in the market is actually producing less than it was before, which contributes to this decrease in quantity that we see for our market here. These negative economic profits cause some of these firms to say, oh, I don't want to be here anymore, I'm going to go do something else. So we actually see exit. This exit, in turn, serves to shift supply to the left, so we have a decrease in supply, but then this decrease in supply in and of itself serves to put prices back up to where they were. So as prices adjust back to where they were, we see the profits for the firms that are left in the market increasing. And what we actually see in the long run is that the price increases such that for an individual firm, they're getting back to the long-run equilibrium price, the original long-run equilibrium quantity, and an economic profit of 0. The overall market effect in the long run is that we go from this quantity here to this quantity here. But it's important to note that because each of the firms is producing the same amount as they were at the very beginning, this decrease in quantity is not due to differences that individual firms are experiencing. It's just due to the fact that there are fewer firms left in this industry than there were before. Putting this all together, we can see that if all of the firms in our market share the same cost structure, meaning they'll have the same costs, expenses, etc., what we see is that our long-run supply curve in this type of competitive market is in fact horizontal. And everything that we've seen up until this point was just a rather long-winded way of explaining why that is the case. Because you notice that whenever we had any sort of market change, our market price always got pulled back to this long-run equilibrium price here. And this is the price that corresponds to the minimum of the average total cost curve for our firms, or the price that corresponds to firm profit of 0. So all of our market forces are driving firm profits back to 0, but firm profit being 0 corresponds to this particular price here. So there's really only one price that can be sustained in this competitive market. And as we move to the right on our supply curve, it's not the case that we have each firm producing more than it did before. Moving to points further and further out on our supply curve just represents situations where we have more firms in our market. So maybe this point here represents where we have 5 firms in a market, then this guy is 10 firms, 15 firms, 20 firms, and so on and so forth. But the important point to remember is that if all of the firms in our market look the same, our long-run supply curve is horizontal or perfectly elastic. So far, we've assumed that all firms in a competitive market are identical, and we've reached the conclusion that in that type of market, our long-run supply curve is horizontal or perfectly elastic. Furthermore, we said because these firms are all identical, they're all going to be producing the same quantity of output, and all the firms in the market are going to make 0 economic profit. let's think about briefly what happens when we relax this assumption of identical firms and talk about a situation in which our firms are not identical. Now, to say that our firms are not identical just means that they experience different costs of production, either because of differences in their production efficiency or because different companies are able to get their materials and so on and so forth at different prices. We can see in this situation here, we're going to get a long-run supply curve that slopes upwards slightly. It's still going to be pretty elastic. It's not going to be as steep as the short-run supply curves that we saw, but it is entirely possible that the long-run supply curve slopes upward a little bit. And that's simply because if different firms have different cost structures, then at a price down here, only the most efficient firms are going to find it profitable to get into this industry. And as the price goes up, we're going to find more and more firms can be profitable in this industry, and we're going to see a higher quantity supplied. So we can see in this case, rather than having all of our firms make zero profit in this type of competitive market, it's really the last firm, that marginal firm that gets in at the end, or you can think about that as the firm with the highest costs that makes zero economic profit. And if it's this highest cost firm that makes zero economic profit, then the others who have lower costs actually can sustain a positive economic profit in the long run. And actually, this is what economists think about when you hear that term competitive advantage. So a competitive advantage that can be sustained in the long run actually allows firms to maintain positive economic profits, whereas otherwise they would not be able to do so.